If you're 62 years or older, or if you have friends and family that are, today's video is for you. We're going to break down reverse mortgages, not those products of yesteryear, but modern day reverse mortgages that will allow you to unlock the equity that you have in your house right now to be able to do things that maybe you've always wanted to do. Maybe it's to supplement your retirement income. Maybe it's to help a family member with a down payment on their first house. Or maybe you want to purchase a new house yourself but you don't want to have a mortgage payment in the future. Well, all three of those scenarios are possible with reverse mortgage. We're going to explore those as well as some other topics today. To help us with the discussion, I have Reid and Matt Harrison from Movement Mortgage. Rob is a local loan officer here in the Richmond, Virginia area, and Matt is his colleague who specializes in this product. Rob, I'm going to start off with you. Every time that we're in a conversation with a bunch of other people and you start talking to people about how you're able to help them with your services, you always drop a hint in there about reverse mortgages. What is it that you love about these things, gets you so passionate about talking about it all the time?
Good morning, Chris and Matt. I'm really excited to be on with you guys to help folks learn about the reverse mortgage world. My background in this vertical was very minimal. My day to day involves forward mortgages, refis, home equity lines, reno loans, those type of things, like a normal loan officer. We have a separate team dedicated exclusively to reverse mortgages. And my first experience in talking reverse was with our national director, Harlan Akala. Harlan is renowned across the United States as a thought leader in this space. He speaks probably, gosh, I don't know, 200, 300 times a year across the United States in the reverse mortgage space. We literally got stuck on a bus for 2 hours in Charlotte. We were touring one of our movement schools, and literally, like I said, we were stuck on a bus, and I had to listen for 2 hours to Harlan about reverse mortgages, and I came away from our conversation with such a thirst to learn more. I read his book. I started jumping on every call that I could regarding reverse mortgages. Matt Harrison, who's on the reverse mortgage team, has become a great teammate of mine, and I've learned so much from him and continue to learn every day that, some of the things we have $14.4 trillion in equity in homes owned by the 62 plus community across the United States. Every day, I think it's 15,000 folks are turning 62 years old in the US. And something like, I could be off a little bit, but 56% of sellers today and 48% of buyers today are over 62. So I think we owe it to ourselves and our clients to learn and help educate on this powerful resource. It's really a Swiss Army knife. There's so many different applications. And myself personally, I'm 58 and a half, so 3.5 years. I'll be 62. I have about 65 to 70% equity in my home right now. Don't think I'm putting extra principal in my house. When I turn 62, day one, I will be doing a reverse mortgage, and I believe in it that much. So, thanks. Yeah.
It's wonderful how a conversation stuck on a bus can really get you engaged in learning more. And one of the things you did was reach out to Matt Harrison, and you introduced us. We had some wonderful conversations along the way. But Matt, how did you get involved in the whole reverse mortgage product?
Yeah, great question. I've been in the industry since 2001, and this reverse mortgage idea did not come to the front until my dad had a big issue. He had a problem. He was in a home that didn't fit his needs. He really wanted to move, and he had. I'll give you a couple numbers. It was a $300,000 home. The home he really wanted to buy was 620,000, and he came to me and asked for advice. I said, "Well, Dad, there's three ways that you can buy this. You can buy it cash, which he could sell his $300,000 home and pull $320,000 from his retirement accounts, but that wasn't the most efficient way to do it. and he wasn't too excited about it. Option two would be to use a normal traditional mortgage, for the additional 320,000 that he needed, but that required a monthly mortgage payment, and he was not very excited to have a payment that would be, north of $2,000 a month. And so I said, Dad, there's another option here. I don't know a whole lot about it. And at the time, let's take us back about 7 or 8 years ago, I really didn't understand reverse. I had an inkling of what it was, but I knew my dad was old enough to qualify for it. So I found out about it. I returned to him and said, Dad, you're not going to believe this, but you only need to bring in $380,000 to purchase a $620,000 home. And he said, well, what's the catch here? I'm like, this is an FHA insured program backed by HUD, and you retain title to the house. You can, sell it at any point. You can make optional payments. There's a lot of bells and whistles to this, Dad, that you can use. He says, well, Matt, why doesn't everyone do this? And that was the moment for me, Chris, where I said, this is something that very few people understand, even those of us who've been in the industry for years. And so it became a focus of mine. It is the only thing that I do. And I spend a lot of my days educating real estate professionals, financial planners, CPAs, and people out there that are interested in learning more about how this program can help provide them really more safety and security in retirement.
That's awesome. That's awesome. Well, thank you both so much for jumping on here. So, as a realtor, I see a lot of homeowners in the Richmond area who are empty nesters. So we'll kind of start with this scenario. They've been in the same house for 25, 30, even 40 years. And a lot of them have dreams about moving, but don't want to potentially have a mortgage in the future. Maybe they want to move closer to family. Maybe they want to have that vacation house, or maybe they just want a home that kind of works for them, not having to deal with stairs or additional space. Um, I think what we'll do is walk through these different scenarios and kind of jump into it. So, scenario number one, we'll use Mary. She's a 78-year-old lady who's a widow. She owns her home outright. The home is valued around $650,000 in Richmond's West End. She, similar to your dad, she wants to move to an area where the home prices are closer to 900,000. So kind of that same $300,000 swing. And she doesn't want to have a mortgage payment in the future. How could a reverse mortgage help Mary, and how would it work? How much equity would she have to bring from her current house for the reverse mortgage? And could she go the rest of her life without having to make a mortgage payment, assuming 4% growth in value each year, and assume Mary lives to 95 years old? What happens then?
Yeah, great question. So, and again, if you're watching this video, maybe you've thought about getting into a home that's a little bit better fit for your needs. And maybe maybe you went to the Parade of Homes or something like that and saw a home, you're like, wow, like that house is really awesome. But gosh, we're in this house. It's only valued at 650. That home that we just walked through is 900 grand. There's just no way we can do that because we're on Social Security or whatnot. And we just don't feel like we want to make a housing payment. Well, the reverse mortgage can be used as financing to purchase your next house. So in this scenario, let's just go through the math. $650,000 home is what she has. In this case, Mary is wanting to get out of this home. Let's say that she pays a full 7% in total cost to sell the home. That leaves her with 604, 500. And now she's trying to decide, what do I want to do with this? Right? Well, the home she really wants is 900 grand. Well, if you use a reverse mortgage, the reverse mortgage is going to require that Mary bring in a certain down payment amount. And that amount would be 533,500. So if she brings in that amount, and she has it because, again, she's got 604,500 from the sale, that would leave her with $71,000 left over that she can park somewhere. She can put it in her savings. She can put it in with a financial planner. She could even put it into the reverse mortgage. We'll get into that in just a minute. But if she does this, she's going to be able to buy a $900,000 home that's going to better fit her needs. She only has to bring in the 533.5, and from that point moving forward, her obligation to make a principal and interest payment becomes completely optional. She can make a payment if she wants to for however much she wants to, but every statement she ever gets in the mail is going to say that her payment obligation is zero. Now, Mary would have to continue to pay property taxes, homeowners insurance, maintain the property, and it does need to typically be her primary residence. She retains title to the house, and really one of two things is going to happen with this home. She's either going to sell it at some point in her lifetime, or she's going to pass away while she's there. If she decides to sell at any point, she will list the property for sale. She'll pay off the mortgage balance. The remaining equity position is hers. If she passes away and she's in the property, then any heirs of her estate have a decision to make as well. Do they want to keep this house or not? If they want to keep it, they figure out a way to refinance or pay off the loan balance. If they don't want the home, they'll list it for sale, pay off the loan balance, and the remaining equity position then goes to the heirs of the estate. And that's going to be the scenario that's going to happen 9 times out of 10, by the way. There is equity remaining, house is sold, it goes to the heirs. Now, there's a great protection with reverse before we get too far into this that is important for us to talk about. This is a non-recourse loan, which means that if for some reason the value of the home was less than the loan balance. So let's kind of reset 2008. Now, we don't want to do that ever, right? But
exactly.
If it did happen, then the heirs of the estate do not have to bring in a single penny. Okay, it's the house that takes care of the debt. So this plan, in this case, we just take it back to simple, provides Mary the opportunity to buy a $900,000 home, only has to bring in 533.5. She does not have to make a monthly mortgage payment as far as principal and interest, and she's able to retain an additional $71,000 in her retirement portfolio. Projecting this forward real fast here, just because people like to see, okay, well, Matt, I've heard that reverse mortgages, if I do that, there's not going to be any equity left for the kids at the end. Well, let me show you how the math pans out on this. You've got a loan balance. In this case, for Mary, it would start out at $398,700. The value is $900,000. And if we have a very conservative average growth rate in the real estate value of the home of, say, 4%, the value of the home is going to increase a little bit every year. The loan balance is also increasing a little bit every year. But again, remember, payments do not need to be made on this. Okay? And at some point, let me just project Mary to age 90. If Mary was to pass away at 90, the projected home value at that point would be about $1.4 million. Her loan balance, about $935,000. So if she was to sell the property at this point, she would be able to pay off the loan balance and have about $505,000 remaining in equity position. Same thing goes if she was to pass away. That's about what would be left over for the kids. But in this scenario, Mary's able to get into her dream house.
Right.
And be able to live in a community that better fits her needs, and she can be there for the rest of her years and still have additional money left over from this purchase at $900,000. So it's amazing. Even if, I mean, let's just say she wanted to buy something at $650. Let's just throw this in real fast. Look at how much money she's going to have left over.
That's awesome.
If she sells at $650 and buys at $650, she's going to have $217,000 of additional cash flow for her retirement left over, and she still does not have to make a payment.
Well, I've got another kind of person that I'm thinking about right now as you're kind of going through that. So we'll have to pull up off the side on that one. That's awesome. That's awesome.
Oh, by the way, can I throw something in real fast, Chris?
Absolutely.
I think this is really important because if someone sells at $650 and wants to buy at $650, okay, there is nothing inherently wrong with paying for a house with cash.
Right.
It happens all the time.
Absolutely.
But what I'm showing you is a more efficient way to manage your cash flow in retirement
Mhm.
so that you have more of it. Because end of the day, retirement's about how much money do we have coming in
Right.
versus how much money do we have going out. And hopefully we have more money coming in than going out. That creates an ability to really enjoy a retirement, right?
Absolutely.
Gang, if I can
Absolutely.
jump in real quick, and this is the part that gets me
Yeah.
so excited that so now you take that 216 plus the fact that you're not making a mortgage payment every month, and what can you do with that money? Like Matt says, I mean, a much more comfortable retirement. You can take all that money and invest it, and that's why we love to have financial advisors in on calls with clients. And then and then of course just a wide array of grandkids and kids and vacations and things that you can do that you may not normally have had access to by keeping all that money in, tied up in your house.
That's awesome. Yeah, great point there, and definitely kind of bringing a team approach here. And I see Matt queuing up here where we're going to throw a mortgage payment in there, just one mortgage payment, and see what the effect of that is. So,
Yeah. So what I'm showing here right now, Chris, and just because Rob, you brought it up, what would happen if you took that in this scenario, $216,000 that you had left over from buying that $650,000 home, and you gave it to a financial planner making 6%, this rate of return? Well, look at your growth of that money through time that you're able to now use in your retirement. It just continues to build and grow for you. So again, talking about efficiency of money, you can put it with a financial planner, allow it to grow. You can also decide to put this money in your line of credit within a reverse. Now, I'm going to hit this in a couple of our other scenarios, but if you decide to make a payment on a reverse mortgage, three beautiful things happen. First, your loan balance will decrease by what you paid. Okay, and you can see that here. Second, all of that money goes into a line of credit that is liquid and growing for you. Do you see how that line continues to build and grow every year? It's just building and building and building. That's the green. That is guaranteed growth in the line of credit, and it is tied to this reverse mortgage. It's actually one of the best features of the reverse, and we'll get into that in some of our other scenarios here. But I think the end of the day, there are so many different options. I think you use the term Swiss Army knife of loans.
uh-huh.
That's really what this is. There are so many different ways that you can use this, which really makes it a financial planning tool as it relates to your home on how you can use it in retirement.
Oh, and that's the thing, having the tools and the options here, and that's what we want to. That's the whole point of doing this. So, well, let's go ahead. Let's jump into scenario number two. So we have John and Susie who purchased their home 10 years ago for $350,000. Now it is valued at about $600,000. John is 70, but Susie is only 62. She just hit 62. They only owe about $100,000 on their home, and they want to stay in that home, but they also want to help their grandchildren with funds for down payments on their first homes, on the grandchildren's first homes. So, what can John and Susie do to free up some of their $500,000 in equity to help their family? And is there a way that they can reduce or eliminate their own mortgage payment along the way?
Yeah, great question. So the very first thing that I'm gonna throw out here is the current position that they're in. So right now they've got a current loan and they are paying, let's just say with $100,000 loan balance, they're paying $700 a month in a monthly payment. Okay. Now there's nothing wrong with having a monthly payment on a house, but I truly believe after the age of 62, there's a more efficient way to do it. So if they decided that they wanted to do a reverse mortgage on their home, the first thing the reverse mortgage is going to do is it is going to pay off their $100,000 loan balance. That is going to immediately increase their cash flow position on the $700 a month that they're currently paying in their mortgage, right? That goes away. So this immediately increases their cash flow by $8,400 a year in payments they don't need to make. Now that's pretty awesome just in and of itself. Along with that, they would have an additional $72,000 in their line of credit. Now, this line of credit, again, has a growth rate. It continues to build for them. And they can use this money if and when they ever need it. They can use it for expenses. They can use it for cash flow for their retirement. They can even use it to draw out to help, their kids or grandkids with, things that they need. Maybe they need to, have a little bit of extra money for a down payment on a house or whatnot. All of this could be available within this line of credit. So the question is, does it make sense to continue to make a payment? Now, I hear all the time, Chris, hey, Matt, I'm fine. Like, I'm okay to make my payment. My interest rate's like 2.5%, which is awesome. But let me pose it to you this way. If I gave you a financial plan, I said, hey, I want you to give me $700 a month as your financial planner for the next 30 years. And I'm going to put it in an illiquid asset, which means you can't take the money back after you've made that payment. And the money you put into it has 0% growth. How excited would you be realistically to invest money with it? You wouldn't. You'd be like, okay, yeah, that's not where I'm putting my money. Unfortunately, for all of us that pay a mortgage payment, that is exactly where that money is going. It is going into an illiquid asset, which is our home. And it has 0% growth because it's the market that will tell us where our value is going, right? So when we look at this and we're trying to decide, all right, what is the very most efficient way to do this? Well, one thing that you could do is you could say, well, Matt, I'm fine making my payment on my current house. Okay. But if you do a reverse mortgage on this house and you decide to put this payment, this wonderful $700 a month, into a couple of different areas, let's see what that's going to do for you as far as your cash flow. Now, again, anytime you make an optional payment on a reverse, three things are going to happen. First, your loan balance will decrease by what you paid. Second, dollar for dollar, that money is going to go into your line of credit where it's liquid and growing. Third, you probably paid some mortgage interest. And there's some wonderful benefits to getting a 1098 tax form at the end of the year that shows you how much interest you paid. We'll save that conversation for a little later. But one thing that I want to highlight here is look at your line of credit growing for you every year because, again, you're just deciding to be more efficient about making a payment. This money is all available for you. In fact, if you made this payment for, I don't know, let's just call it 15 years, you now have $435,000 sitting in that line of credit.
That's awesome.
There's a lot of different ways that you can use $435,000 in your retirement, right?
Absolutely. And this is keeping the control of the cash as opposed to just having no control over the equity whatsoever. I mean, it's all about control with regards to what you can do with that equity. You're either giving it to somebody else, or you're going to be able to play with it, maximize it on your own with your own control.
Absolutely. So you can put it here, or of course, and this will take me just 2 seconds here, you can put it with a financial planner.
Mm-hmm.
Right? So if we take this same $700 a month and I decide to get it to a financial planner instead, and I'm just going to have a really conservative 6% growth rate on that money, look at how this builds for you in your retirement.
Mm-hmm.
Okay. Now, again, I'm going to take this to 77. That's 15 years out. Where would you rather have your money? Honestly, you could be making a payment with a 2.5% interest rate on a normal traditional mortgage, and there's nothing wrong with that, but you cannot access that money.
Right.
You could instead put this money in with a financial planner, allow it to grow for you, allow it to build. And this would give you, like I said, an additional $203,000. That's on top of your line of credit growth that you would have in your reverse mortgage. If you kind of like put the two of those together, again, you're looking at a blended amount here of about $435,000, depending on where you put that money.
Mm-hmm.
I don't know about you, Chris and Rob, but for me, I would much rather have liquidity in my retirement and have
Absolutely.
this option.
Absolutely. That's awesome. That's awesome. This is based off of real life people. I look forward to sharing this video with them so that they can see the opportunities that exist for them right now that they can do with reverse mortgages. So, Matt, any more on this one before I jump on to scenario number 3?
No, let's move on.
Okay.
Let's do it.
All
Can I
right.
jump in real
Sounds
quick,
great.
Chris?
Yeah,
I'm sorry.
absolutely.
So you mentioned about, sharing this with folks. That's one thing that
Yeah.
this doesn't have to be a big webinar. This doesn't have to come in
Right.
and listen to. This is a great intro. But Matt and I every day, I try to burn him up with phone calls, but it's a lot of one-on-one with clients because
Yep.
it's not something they've ever heard about. So let us sit down, let us educate. Matt is such a good teacher. And that's the part that I want to emphasize, that this is not
Mhm.
something that, okay, I can't wrestle it down to one-on-one.
Right.
That's where.
Exactly. This isn't I fit number 3. It is, hey, this is my situation. How can the reverse work? And really kind of opening up that blank canvas there with regards to what you want to do.
For sure.
So, all right, cool. Let's scenario number 3. So this is another real life scenario. It's actually a friend of mine who is kind of in this situation. We've had this conversation, and I want her to actually reach out to you all and see how y'all can help. But Carol has lived in her home for a couple of decades and really owns it outright. She is 75 years old, but she feels like she still needs to work to make ends meet. Her home is valued at $400,000. She would like to get some equity out of the house to make some repairs and would like to have additional funds on a monthly basis to help ease her mind on affordability. How would a reverse mortgage help in her situation, Matt?
Yeah, this is such a great example. There are so many seniors right now that are, let's just call it, they're house rich, cash poor. They have a home, they have it close to paid off or paid off. They have all of this equity, but as you know, that equity is not touchable. You can't chisel off a brick on the side of your house and take it to Home Depot and buy things with it, right? You can't do it that way. So the only way to convert that home equity into cash is one of 3 ways. You can sell the property, you can do a normal traditional loan or home equity line of credit, but both of those are going to require that you have to make a monthly mortgage payment back on it. Or 3, you can open up a line of credit within a reverse mortgage that can provide you with cash flow without the necessity of needing to make a monthly mortgage payment back on it. And this line of credit grows. So for this example, a $400,000 home value, after the costs of doing a reverse mortgage, okay, which gets added into the loan balance, this particular client, Carol, would have a line of credit that would start out about $147,000 strong. Now, of that, there's a certain percentage that she would have access to in the first year. It would be about $80,000 for her. Okay, now this is a cap that's set by FHA and HUD, but how this projects through time is really fascinating. So she starts out with a line of credit of about 147. That continues to build every year. It just continues to grow. And to be honest with you, there's a lot of people, Chris, that start out with a reverse mortgage that don't really need it. In fact, I would make the assertion the very best time to start a reverse is when you don't need it. Because again, you have this compounding growth in your line of credit. This is available money that you could draw at any point in the future if you need it. Okay, and that's really important. When we look at how this money could be taken, Carol could use it in a lot of different ways. Obviously, she could take out a lump sum of money right off the get-go and use it. But I find a majority of the people that we work with will draw the line of credit as they need it or set it up to where it's paying them on a month-to-month basis. And let me kind of show you how this would pan out here. So if she started her reverse mortgage and immediately just wanted to have a monthly payment coming to her every month for the rest of her life, she would have a monthly payout of $1,046 per month, no matter how long she lived, if she started it at 75 based upon her value and her age. Every year that she waits to start that line of credit grows a little bit more, as does the lifetime payout that she would be able to get on a monthly basis. So you can see how this continues to build through time. Let's say that she didn't need it right now, right? She's okay to wait. And at age 80, she says, you know what? It would be really nice to supplement my Social Security income by an additional $1,600 a month. That would be pretty game changing. And for some people, it's life changing. So again, this is something in Carol's position. Her home is only valued at about, what is it, 400,000?
Yep.
So someone that has a higher valued home, these numbers get even stronger and get even bigger, right? I'm just going to throw in a little bit of a curve here. Let's say we're a 62-year-old, and I'm going to say that you have someone that's got a pretty nice house and they have it paid for free and clear, 750 grand. Well, if they want to do a reverse on this, look at their line of credit growth every single year. It continues to build. If they started this at 62, by the time they're 82, they have almost $900,000 in their line of credit.
Wow.
Okay. If you look at how this would convert as far as a payment coming to them at age 80 or 82, it's an additional $7,376 a month in additional cash flow for them for the rest of their retirement. Even if they turned it on at age 70 or 74, I have a lot of clients that kind of pick 74 to 75. Who wouldn't want to increase their cash flow position by an additional $3,900 a month for the rest of their life?
Absolutely. And I think that's what Rob's strategy is here. Is he's thinking about jumping.
and let's an example. I mean, we talk about in Carol too. Let's say she needs or would like to take out 20,000 to do some home repairs or whatever. You know, maybe it's a vacation or you know, helping with a wedding or whatever that may be. There's still scenarios, and you know, obviously you're not going to have as much per month to work with, but you can do both. Again, bring out that Swiss Army knife.
Right.
Exactly.
That's awesome.
This becomes the reverse mortgage, in my mind, creates a tool that is your home. You can now use your home, which has a lot of money in it, to be able to fund things that you need to do in your retirement years. So you can take money out and you can put money back. That's what makes this a lot of fun. Okay, this is a tool that, again, can build and grow for you through time, continues to be available for you. And again, your obligations on this are simple. Continue to pay property taxes, homeowners insurance, maintain the property, keep it as your primary residence. That's what you're agreeing to. You have to be at least 62. Now, if you're married and you're 62, and let's say your spouse is 55, you can still do a reverse mortgage.
Okay.
We base it on the youngest borrower or non-borrowing spouse. But the non-borrowing spouse still has the rights of the reverse mortgage as far as being able to stay in that home if the borrower passes. There are all sorts of protections in place, but as both of you have already kind of mentioned, we love helping people. I mean, we do. We love going through individual scenarios. Everyone has their own story. Everybody has their own goals. What we like to do is help you look down the pathway that you're currently on. What does that look like? And then compare that pathway to what life would look like if you implement a reverse mortgage. Now, it's not going to be perfect for everybody, but for those that look at it and say, okay, this looks like it could be a lot of fun, we can then develop the strategy around it and help you implement it, whether it's using a reverse on a home that you're currently in or really finding a home that you want to be in retirement. The reason my dad, to be honest with you, wanted to move when he made his decision is he said, Matt, the home I'm in is just a little too small. I want to have a pool and I want to make sure that I can age in place. I want to make sure that when I get to the point that I might need care, I don't have to leave this house. I can have care come to me instead of me going to, a retirement, home or something like that. I'd much rather be here. So
That's awesome.
The home that he purchased and built allows for all of that.
Mm-hmm.
So this can create planning options that may not be there otherwise.
Mm-hmm.
Because again, in retirement, cash flow is very important. You look at this scenario for Carol, look at where she would be. Let's say that she makes it to age 90.
Mm-hmm.
Well, if her line of credit was not touched, it would have grown to about $427,000. I can put a good deal of confidence in her ability to have care come to her
Mm-hmm.
and allow her to stay in her home instead
That's
of
awesome.
having to move.
That's awesome. That's awesome. Well, I can see right now, and I appreciate you all's time. This really is kind of a case by case scenario. We could sit here all day and have all sorts of different scenarios and bounce around things. I guess the question is, if somebody wants to learn more about reverse mortgages, I'm trusting that go through Rob, and then Rob can connect them with you, Matt, and kind of go through all the scenarios and really break it down.
Yeah, we're on the same team. Rob and I work together, and reverse is what I do, and so as his team member, that's how I am able to help. And again, this is not a hard sell. This is about allowing people to be educated on a program that's very misunderstood and allow them to see how this could relate to them. And I can promise you, every single person that is watching this video knows someone that is over 62, is either still making a payment on their house, they own it free and clear, or they're in a home that they'd rather not be in. They'd rather move into something different. And so we would love to have the opportunity to work on this. And Chris, I've got to give you kudos. As a real estate professional, there are very few out there that understand how different programs can work in conjunction with aging and getting into a home that's going to be a better fit for your needs. And you have done a great job in focusing in on this segment, of our population to, really be able to help them achieve those goals. So, Chris, thank you. We really appreciate the friendship and the time.
Well, thank you for that. It's one of those things where I really see the need here. I have personal exposure in my own life and can relate some of these things. So, I really do appreciate you all's time to be able to pull this together. And it's all about bringing awareness so that way everybody knows and can understand there are options out there that they can go forward with and use. So I hope this at least opens up some people's minds and able to kind of bring them along to ask questions, to reach out to Rob, so that way we can have more conversations like this. So, anything else that anybody needs to know before we cut free?
No, I would say the only thing, again, I would throw out there is education is power. Learn about it. Get yourself educated. Allow us to run through scenarios for you so that you can see what this is. I mean, I just turned 50. I already have a reverse mortgage as a part of my plan in my retirement, and my financial planner and I have been working on it for years. I still have to wait 12 years before I get there. So the original magic age, don't think that you have to wait until 62 to have a conversation to start this planning process. Because again, I promise you, what we have to talk about is going to put a smile on your face.
Good deal. Good
Absolutely.
deal. That's
And I'll
awesome.
just
That's
second
awesome.
what Matt said. Chris, thank you so much for putting this together and really bringing the awareness out. And again, anybody that's watching this that has questions, and you will, don't be bashful. I mean, we are here to help, and we will hop on a call. We can do 15, 30, 60, whatever you need. We're here to help you.
Awesome. Awesome. So what I'll do is I'm going to put you all's information in the comments and the description below. So that way people can reach out to you directly, Rob. If you're watching this and you got something out of this, I'd love for you to like this video, to share this video with somebody that you know. Like Matt said, everybody knows somebody who's 62 years or older who is making a mortgage payment or has a lot of equity in their house that most likely they want to be able to use. So guys, thank you very much. I really do appreciate this. Everybody, thank you so much for watching, and like and share, and we'll catch you on the next video. I'm Chris Rouse, Better Homes and Gardens Real Estate Base Camp. Appreciate your time today.